Hey everybody, Ace here. There is so much you need to know when it comes to investing. So if you didn't watch my previous video on different investment accounts, I'm going to link that up above for you so you can watch that. And in this video, I'm going to walk you through 4 basic investments that you need to know about, or you will most likely hear out in the workforce. And the first thing you're going to need to know is stock. What is stock? Stock of a company is all of the shares into which ownership of the corporation is divided. The shares are collectively known as stock. A single share of stock represents a fractional ownership of the corporation. When you own stock, you own a portion of a certain corporation. So if you were to buy stock in Apple or stock in Amazon, you will own a share, or you will be a partial owner of that company. So when you think about it, any company that is on the stock market is stock that can be owned. So everything I'm going to talk to after this is going to refer back to stocks. Next is an index fund. An index fund tracks a certain set of stocks, whether that be tracking the S&P 500, the entire stock market, or it can even track a certain section of stocks, whether that be in energy or retail, tech, it doesn't matter. Index funds are the most common investments out there. They give solid returns year over year, averaging 7% across the board, and they have some of the lowest fees attached to them. And what does that mean? That means you are paying the least amount of money to invest into an index fund than you would be with either a mutual fund or a target date retirement fund. Some of my favorite index funds to invest into are VOO, which is the Vanguard S&P 500 Index Fund, and VTI, which is the Vanguard Total Stock Market Index Fund. So what do these do? Well, VOO tracks the S&P 500. So when the S&P 500 goes up, VOO is going up. When the S&P 500 is down, VOO goes down. VTI tracks the entire stock market. Same concept. If the entire stock market is moving up, VTI will move up with it. If it's down, it will be going down as well. Next is a mutual fund. What is a mutual fund? Well, a mutual fund is a professionally managed investment fund that pools together your money to purchase securities. What does that mean? That means it's just like your index fund, but it's professionally managed by someone else. They'll buy at certain times, they'll sell at other times, and they're gonna manage that fund to try to get the best return possible for you. But the catch is they're charging you a fee to invest into that mutual fund. Mutual funds typically have much higher fees associated with them than index funds, which means you're gonna be paying more of your earnings or more of your money to that person managing your fund than you would in an index fund. I personally do not use any mutual funds. I am all index funds. Reason being, the fees are lower, and I am more of a long-term passive management style of investor. There are a lot of great mutual funds out there, and a lot of them have solid performance every year. You just need to weigh as an investor, are the fees that you're paying worth the money you're getting in return? If you think they are, fantastic, keep doing it. If you don't think they are, maybe it's time to switch your money out of a mutual fund, or don't even invest into that mutual fund and invest into something like an index fund with lower fees and solid returns. And lastly, we're going to talk about a target date retirement fund. A target date retirement fund sets a specific date for retirement, and that fund's assets will change as you get closer to that target date. And a target date retirement fund is going to have a lot of individual stocks in the beginning and be a lot more aggressive for growth. And as you get closer to that target date retirement that's set, so for example, if it's 2060, it's going to be really aggressive in the 2020s, but as you get into the 2050s, closer to the 2060 target date, it's going to be a lot less aggressive. So instead of owning individual stocks, it'll own more bonds and have more cash assets and less in stocks. I am not a financial advisor, and none of this should be taken as financial advice. I myself personally love investing into index funds and individual stocks. I don't mess around too much with mutual funds or target date retirement funds, and the main reason being is the fees that are associated with it. But any of those 4 that I listed would be fantastic options to invest into. You as an investor just need to establish what you would prefer your risk to reward ratio to be, as well as what fees you're willing to pay. If you like this video, please just tap that thumbs up button for me. That'd be fantastic. Subscribe for more content. And until then, I'll see you in the next video.